Hello, everyone, and welcome back to this Family Building Society podcast on later life lending. I am joined by Darren Deacon, Head of Intermediary Sales of Family Building Society, Edward Payne, Director of Clifton Mortgages, and Michael Craig, Managing Director at Brilliant Solutions. And going to Edward and Michael, do you think lenders as a whole need to have a more flexible approach towards age, or kind of, does there need to be some wider kind of criteria changes in this space? And if you could change some things, what would they be?
I'd say I kind of like the regulator to take a different view in terms of older clients, because, okay, lending into retirement is a high risk area. Clients on interest only mortgages in later life is a very high risk area. But just by pushing lenders to continually write letters to them and say, you've got to pay this off, if they could pay it off, they would have paid it off. And these are very often customers that have had this mortgage for 20, 30 years, often on SVR, not on the best deals that are out there. They've got very good payment profiles. And a lot of the time, they can't quite get enough with a lifetime mortgage to help themselves out. Things like sole survivor income on Rios means, again, very often they can't afford the mortgage. So ultimately, I think from a capital adequacy perspective, this isn't a major risk for banks. There are a lot of interest-only mortgages out there, but for those vulnerable customers, vulnerable old customers that are out there, it makes up quite a small proportion of lending. And to be allowing lenders to continually send out 20 odd letters saying we're going to take your house off you does not fit in with consumer duty from my perspective. We need to take more practical steps to deal with it. If somebody can earn the money, they've shown they've got a track record to earn the money, there are institutions out there that will lend to them. And there's a number of institutions that will go to, 75, 80, Family Building Society, take it that step further. But they do it in a responsible way. They only do it for people who can actually show that they can afford the mortgage. And they're just slightly more creative in terms of the way they view that income and give the customers a bit more credit.
Michael, do you have anything to add to that?
Yeah, I think I've said many a times that our industry is really, really good at talking about things. Where our industry probably fails is actually changing anything. I have plenty of meetings across the industry about different products, about how we think we can support consumers more. And we talk a good game, but we don't really change an awful lot. And that comes following from enterprise. And of course, from the regulator. The regulator has to get involved and not just tell us we have to look at it from our own interpretation, actually give us a black and white indication as to what they're going to do to support this market. For me, for any brokers I talk to, says one or two things happens. They either sell the house, the multiple letters from lenders saying, you need to sell this house because we want our money back, or they go straight into equity release space. And there's this big, big misinterpretation of what actually later life lending Rios can do in that space between the two. And from my perspective, Ed's right, it is more high risk, but what's more guaranteed, a pension or a job, especially right now? So for me, I want to see more support from the regulator for the likes of Family Building Society that are coming out with these ideas to say, look, this is how we can lend, and people are living longer. So I go back to my first point, the Bank of Mum and Dad stimulates our market in different ways, and we need to support that stimulation to help the first-time buyer market by helping the Bank of Mum and Dad, nan and granddad, auntie, uncle, whatever it may be, to try and prolong and bring these first-time buyers onto our market. And for me, the best way to do that is by looking at the top of the market, which is the later life lending side of it.
I suppose kind of looking ahead for the coming year, do you expect, I'll go to Darren first, do you expect there to be any change in the makeup of later life lending inquiries you're getting in? Do you expect there to be more inquiries on certain kinds of products?
Well, yeah, probably going back to joint borrower sole proprietor is still an issue for those first-time buyers to have the income and the affordability. Cost of living is still there, and lenders, credit scoring, etc., is still a tough bar to get over. So yeah, there's always going to be the need for older borrowers to assist. So and just in general, as I said right from the top, people want to live their lives. I think the generation of those type of customers that get to 60, 65 and think, well, that's my mortgage paid off, I'm happy, and that I'm done effectively in terms of work and sort of pipe and slippers for want of a better phrase, and that they still want to get out. They want to live their lives. I mean, people are still living in the same homes, or they think by the time they're 75, they don't want to be living in that property any longer. But they get to the age of 75 and think, well, here I am, I'm fit, I'm healthy, I still want to live in the family home. So they're not ready to downsize. So there's a need for that. And UK Finance predicted that the growth of the market, yes, we've hit some bumps since 2021 through coming out of COVID and the trust quartang dance that was done in 2022 certainly hit things. But the market at the time was doing somewhere in the region of 28 billion pounds. It's predicted by 2030, according to UK Finance, that's going to grow to 40 billion. So the optimism's there, the need is there, the want's there, and I think, to pick up everything that Mike and Ed has said there, is the need and the want of the customer.
Ed and Mike, do you have anything to add to that?
We're seeing this holistic advice being given by brokers now to understand not just what their current customer wants, whether that be son, daughter, what the family has in order to get son, daughter to where they need to be. And I think from our perspective, we will continually get, as a packager, an array of different inquiries and different conversations with brokers, because it's what we're here to do. We're here to try and give them a second opinion to ensure that actually we can get to that point, which means how do you get that customer from A to Z? I think unless more lenders like Family are doing right now, and Family are changing the landscape from this perspective to come in with different ideas and different permutations, how can we best serve our customers if lenders aren't looking to change it? And I think what Family are doing is giving us the arsenal, you used the word earlier, to actually go to these brokers, or who can then go to their customers to say, do you know what? We have a way of doing this. We have an idea. This is what it looks like. This is the journey. We're no longer in a low interest rate driven industry. We are now in a criteria driven industry, as I like to call it, which is helping customers with their circumstances, which are so much more complex than they were 2 or 3 years ago, because they have to be, and people's lives are different. And I know it sounds a little bit corny to say, and Darren mentioned about the family home. I don't think I'd ever want to sell this house that we live in. All of my 3 children were born in it. They will grow up in this house. We won't move. I've had many conversations about moving, and you always go back to the fact that actually the first time these children came home to a home, they came to this house, and they've grown up in this house. So at 75, will I want to sell it and downsize? I don't think so. I think I'll live here until the inevitable happens, unfortunately. So how would I get money out of my house later from my children? I think it comes down to this innovation for the likes of Family that can actually go, do you know what? This is what we can do, and this is how we can support you. Because I don't think anyone deep down wants to sell the family home. Some might do from a health perspective, might move into a bungalow for obvious reasons. But I don't think deep down anyone actually wants to sell the family home, where the kids were brought up, where the kids moved into, where the kids left and came back, or whatever it may be. I think going back to the idea of selling the family home, I think it's gone. I don't think it happens anymore. I think they want to stay, and they want to pull money out. And I think that's where the likes of Family come in. So for my opinion, will we see any difference? No, I think we'll see more and more of this type of inquiry, and we are seeing more and more of this type of inquiry coming through.
Great. Ed, do you have anything to add to that?
Yeah, I think necessity is the mother of invention. Competition could be called the father of invention, and we've got a lot of different things coming in. One of the things that I've really noticed in this sector at the moment is hybrid products that are starting to come out from more lifetime lenders, where they're looking to effectively do a RIO that then rolls into a lifetime mortgage. A lot of customers just can't borrow enough through a lifetime mortgage at the moment because of increased interest rates. So I think that's going to help in that sector. And especially for people who maybe got income now but don't won't necessarily have the retirement income moving forward. So, that's one piece of the jigsaw for sure. Going on to what the guys are talking about with Bank of Mum and Dad, what we're really talking about here is passing housing wealth on to the next generation. If you go back, people start talking about high interest rates of the 80s. Yeah, okay, they did go up to 15%, but people were only borrowing 3 times their salary. Now I've got customers coming in to see me borrowing 5.5 times their joint salary, which is all well and good. But then if they have children in a few years' time, their income takes a hit. There's real issues there. So I think passing wealth on to allowing people to own home is going to be integral to the future success and stability of the market. Joint borrower sole proprietor, yeah, it's a great thing. A lot of the time, to be honest, customers come in to see me, ask about it, and it very often doesn't work because of the maximum age of the sponsor. Now, a family, they take a much broader view in terms of maximum age and the amount of income or type of income that can be taken into account. So I can get deals to work with family that I can't get to work elsewhere. But very often that is an issue. We also saw a big thing a few years ago where people were starting to talk about collateralized charge mortgages, where they were looking at equity within homes in lieu of a deposit and spreading the risk effectively over 2 properties. And for whatever reason, that hasn't really taken off. But I do still think there's a real opportunity for that kind of product moving forward. For me, more lenders taking a view on age of sponsors on joint borrower sole proprietor and following their lead is absolutely needed. Not restricting RIOs and term interest only mortgages based on survivor income. Again, that is absolutely needed. I wouldn't turn around to a couple of first-time buyers and say, well, you might have children in a couple of years, so I'm only going to take one salary into account. We stopped doing that back in the 1990s. So I don't see why we're taking that approach with older clients. Well, older clients aren't naive. If one of them passes away and their income goes down dramatically, then they will potentially be forced to downsize, or in many cases they will want to downsize. And I think we need to give older clients credit. Vulnerability and lack of capacity is not, or understanding is not just an age-driven issue, and we need to be treating older clients on their merits.
I think that's a really great note to end this session of the podcast on. Thank you all for your great contributions. Please tune in for our next session, which will be looking at brokers and packages. Thank you so much.